Happy Friday, everyone. Jason Jacoby, certified financial planner and wealth advisor here at Boyer Financial Services in Newport Beach. Hope you all are doing well, and it is officially the Christmas season. I'm really excited about it. I've been celebrating Christmas since before Thanksgiving. We had our tree up before Thanksgiving. We just love Christmas and just all of that it means, not only for our faith, but also just spending time with friends and family and the good food and the great music. It's just a fun time to be together. So looking forward to seeing more lights up and around town and everyone getting in the Christmas spirit. But anyways, lots to unpack here. A couple of things I want to touch on for this week. First of all, let's just give a market synopsis. It's kind of a wild week. Markets were down a couple hundred points, kind of rallied back. Some days it ended flat or down, but overall we had an up week in the market, led by the Nasdaq up over 2%. The S&P 500 was up a little bit over 1%, and the Dow Jones was up about 0.2%, I believe. So relatively flat week, but a good week for tech, which is because of the news that we'll talk about next, which is Fed Chair Jay Powell's speech this week at the Brookings Institute. Had a little bit more of a dovish tone, which basically just means that the Fed is probably going to raise rates at a slower pace this next month, probably a 50 basis point rate hike, followed by potentially lower rate hikes in the future. Again, that's to be seen as economic data comes out, but that's what he basically suggested at this speech this week, which is a good thing. Obviously, our tech companies, our growth companies gotten hit hardest this year because those companies that are investing in innovation and borrowing money have to pay more in interest when they borrow that money now. Whereas the prior decade, we've been in a low interest rate, low inflation, low global growth phase. Really benefited the tech sector and the growth sectors there, thus the huge returns that we've had. But now it's coming back to earth. And so basically that just means that the Fed, more than likely, as they increase the rates, might go slower because of they're waiting to see how these past rate hikes that have been so not overblown, but substantial in size and speed. That's the reason for the bad bond market we've had this year. But they're going to go to a slower pace now because, again, like we talked about in previous closing bells, it takes a few months, at least a few months, for the interest rate hikes that have taken place to get baked into the economy. We see it in certain sectors get hit a little bit harder than others. Unemployment in certain sectors, job decreases, and firings have increased again in certain sectors. So, with that being said, the job number, the payroll gain for this past month is just it's been incredible. Considering the economic environment, payroll added about 263,000 jobs, which is 63,000 more jobs than anticipated. So pre-pandemic average, non-farm payrolls monthly change was about a little under 200,000, probably 180,000 or so. We've been, substantially above that since COVID, obviously, with the reopenings, but for adding 263,000 jobs in November, which was over 63,000 jobs more than expected, specifically a majority in the hospitality and leisure sector, which I tend to believe going into the holiday season, people are getting short-term employment in these places. So the economy is saying, well, how are we in a recession or going into a recession? Whatever you may believe, how are we doing that when we have such a strong labor market? And does that mean that the Fed's going to keep hiking rates at substantial numbers? No, it doesn't mean that. As Fed Chair Jay Powell said this week, it's probably not the case. Because once you dive into the numbers a little bit more, it's going to show that actually real hours worked on a weekly basis by the private sector actually decreased. Unemployment's still at 3.7%, so that didn't change. But again, you're just starting to see some cracks in different sectors. Again, with some layoffs to less hours worked, so labor force participation. We had some decent wage growth at over 5%, at 5.1%. which is quite surprising again. So it's kind of a weird conundrum that we're in right now. Kind of feel like we're in like a washing machine going around and around. You get some good numbers, which equals bad news, and then you get some bad numbers, which could equal good news. And again, where rates won't be raised as much or as quickly. So it's kind of a weird scenario that we're in. But anyway, my point with this being, rates were closer to the end of the rate hikes than the beginning. Should be seeing that stop here soon, or at least slow down quite substantially while we watch the rest of the rate hikes get baked into the economy. It is 2023 will be a volatile year. Companies that have steady cash flow, consistent earnings and profits are going to be the winners, in my opinion. And obviously, we're big fans with our investment strategy of dividend payers and dividend growers to be the core holding. And obviously, you can have a growth sleeve, a growth enhancement, an income enhancement, different sleeves, bonds, things of that nature, alternative investments. So there are other things that you can add around it, but that's basically where we think, if you look at the historical numbers, portfolios tend to do well over long periods of time when they have the dividend paying companies that have been around and weathered all market cycles and types of economies. So last thing I want to touch on is the dollar, King dollar. It's been super strong lately. I'm sure you've all seen that, especially if you traveled abroad. You've got some pretty good exchange rates out there. So what does that mean? Like, how does the interest rates affect the dollar? Well, when interest rates are increasing here, because the dollar is basically the reserve currency of the world in times of geopolitical uncertainty and other times as well, we're kind of like the light on the shining light on the hill per se, where a lot of people, a lot of foreign investors and countries actually come to the U.S. and buy our dollar, buy our money, buy our treasuries, things of that nature, our securities, which basically is not a good thing for the U.S. investor, because if they're owning international investments, a U.S. investor owning international investments, when they do that currency exchange, they're actually losing a portion of their return because it has to convert to the strong U.S. dollar. So in that space, it's good for the foreign investor just from the aspect of security. They are buying a currency that the world uses, and they know that it's not going anywhere. So in times of uncertainty, they flock to the dollar, which makes it stronger. But when Fed Chair Jay Powell said that they were going to lower rates, or not lower rates, but increase them at lower rates, that actually strengthened the British pound, the euro, the Japanese yen, different foreign currencies that had been weakened by the strong dollar, because now you're getting more comparable rates around the world. So therefore, countries or investors start buying different currencies, making them stronger, taking away some of the luster of the strong US dollar, weakening it essentially, which isn't bad for international investing here in the United States for the US investor and multinational companies when they have earnings outside the US and have to convert them to dollars too. So it's interesting. So is it the end of the King dollar? At this point, no, it's not. It's going to be a strong dollar here for the time being. We do see it weakening over the intermediate and long term. So as we move into the middle and late 2020s, dollar will continue to weaken, in our opinion, especially as rates start to even out and come down. And we should get back to more a little bit more tailwind for international investing. Last thing I want to touch on, really excited, sports world. I'm a big sports fan, played football in college myself, but really excited about the U.S. men's national team at the World Cup. They've done so well so far. Excited for the game tomorrow morning. Hopefully we can beat Netherlands, and we can talk about it next week on the closing bell. And then also our USC Trojans tonight, Pac-12 championship game, some redemption, lost to Utah earlier in the year. So hopefully they can get it done and get in that college football playoff, which would just be fun to watch. Be fun to watch USC, even though their defense is kind of lackluster, though they did step up this last game. Hopefully they can stop some opponents going forward. But anyway, this is Jason Jacoby for your Friday closing bell. We'll see you next week.